Hello everybody, my name is Jan and today we'll be discussing a little bit more about the proprietary system. So Amphifin has two sides. We have the open source framework that is live on GitHub and a proprietary system with a little bit more features involved. There are, differences, but they're a little bit more similar as well. The open source framework is meant to, mimic the architecture of the proprietary system, but the proprietary system has a little bit more monetary investment involved. For example, in terms of data source, our proprietary system uses Data Bento to train our models. We used to use Intrinio as well. The open source framework uses YFinance, and we are slowly transitioning to using IDKR. We also use, on the proprietary system, we also use two specialized LLMs, one to collect analyst ratings and the other one is to collect investment company portfolio to track their changes and portfolio value changes as well. So yeah, let's get started on discussing a little bit more specific about our models. So I guess we'll go first on the Prague and Hybrid model. Actually, I'll go over the overall ensemble approach. So Amphifin's strength lies, on a ranked ensemble learning system, but it's actually a double-layered ensemble learning system. So we have, 8 models. Excluding the big model, actually we have 7 models. We have 7 models here. And what we do is we basically rank our 7 models. And within our 7 models, it also ranks other things as well. So Ether, Techion, Euler, Prague, Hyper, Riemann, Sigma, there's also ensemble learning involved within those models themselves. But our Amphifin system, uses ensemble learning to rank those 7 models. So there's, different approaches, and that's, what the ensemble learning system is about. So yeah, I'll discuss a little bit more about the big model. It's a little bit more different than what version 3 has. So yeah, let's get started. The Prague and the Hyper model, they both use ensemble learning, and they're both technical indicator models. I will say, if you look at that GitHub, if you look at our GitHub, besides the data source, and there's a little bit more features involved. Actually, I wouldn't say there's quite a difference in the architecture, in terms of the architecture. But excluding data source, the Prague and Hyper model is pretty much the same. They have the same architecture. The difference is that the Prague model was trained under pragmatic conditions, which is why it's called the Prague model. So it was trained, on the 2008 market crash, 2001 dot-com bubble crash, the 2020 Corona crash. It was also trained when the 2022 interest hiked. So yeah, it's there, during, I guess, high volatility. So when the VIX indicator is up, that's where our Prague model kicks in. Our Hyper model, it's more for high growth. So most of the times our Hyper model is taken over the Prague model because, the bull market is longer than the bear market in general. But yeah, the Hyper model is, trained during, low volatility but upward growth bull markets. So, between different market crashes, that's where the Hyper model was trained under. The Riemann model, it's to evaluate analyst calls. So it actually does ensemble learning on the analysts. It actually ranks those analysts and give them credibility ratings, which is then, later multiplied with their decision to get the overall decision of the Riemann model. So, that's a little bit more convoluted. So I will discuss it a little bit more in detail. So let's say analyst A, predicts, Apple to go up the next day. Turns out Apple does go up. We then give that analyst, higher credibility, a higher rating, and that higher rating translates when, when the analyst, that same analyst predicts something else as well. So their decision gets multiplied with that coefficient. let's say an analyst, predicts Apple to go up, but it goes down. Then we cut that analyst's rating. We basically deduct their credibility point. And yeah, that translates to the overall decision of the REMO model. So we aggregate the decision. Let's say we're interested in using Amazon. So it tracks, what analysts said, something about Amazon. Let's say it's going to go up, it's going to go down. And based on those analysts' past performance, we basically multiply their decision with the coefficient that is assigned to them. And, output our prediction using the REMO model. So yeah, that's that. The Euler model, it's a little bit more of the predictive model. So I will say, Euler and Techion, they're two of our, I would say, I don't want to say the worst performers, but they're very much, very different from the rest. So the Euler model is for predictive case, so it tries to predict, market conditions, and right now it's right about 60% of the times, which sounds really bad, but in a high volatility condition, it's actually decent. It's still one of our worst performing models. It's currently ranked 7th as well. So yeah, that's that. We have our Techion model. So what it does is it tries to exploit cross-market inefficiencies. So if one asset is priced at this price at X market and Y market, another price pops up for that same asset, then it tries to exploit those inefficiencies. And yeah, so that's there. I will say, the Techion model, although it's 6th in our ranking, but what I will say is that it's one of our least volatile model in terms of returns. It's very consistent, but they are very low returns. That is one thing to note about the Techion model. The Ether model. So the Ether model doesn't actually trade, which you might be like, then what does it serve? So it's our sentiment analysis. So what we do is monitor VIX index, we monitor gold prices, and we also monitor other different economic indicators. I mean, one thing we do monitor also is the so-called Buffett indicator as well, which is really cool. And what we do is we try to predict, macro trends. Is the overall market going to go up? Is it going to go down? Things like that. So what I'll say, the difference between the Ether model and the Euler model is that the Euler model tries to do statistical modeling. It tries to predict actual, graph data, like the market is going to go up or down, the graph data. Ether model just gives it, is it going to go up? Is it going to go down? Euler model tries to predict, the upward path, the downward path. And that's why, it's those two different indicators, they're very valuable. These two models are very valuable in their own rights. So the Ether model, although it doesn't, directly switch different models, it plays a key part because it supplies that data. So yes, that's that. And finally, the Sigma model. So this was an improvement from version 2. So what we do is we track investment company portfolios, and we actually ranked investment companies. So let's say, a certain investment company, I will say from the ground, let's take it back. Let's say, an investment company pops up and we track their portfolio using their 13F reports. And then on the next quarter, we track their 13F filings again. And let's say, their investment portfolio went upwards. Then we give them higher credibility. And, the next time they buy something, we basically multiply it with the coefficient. This is the same thing as the analyst ratings as well, but we do it based on profitability margins based on different trades. We also do it based on their portfolio change between different quarters. And there is some recency bias involved, but it's not too much. So yeah, that's pretty much that. That's pretty much our 7 key models. So that is version 3.0.1. For version 4.0.1, we use what's called dynamic fine-tuning architecture, which is our big model. And what we do is, different models, they have discrete parameters to switch between on different market conditions. It's pre-programmed into them. And that was for version 3. But for version 4, what we found out was that, if you do dynamic fine tuning, which is, switching between, not unpredefined, it's not switching between predefined parameters, but it's actually, decrementing them, incrementing them, multiplying them by some coefficients, basically fine tuning them live on trade. They actually perform much better, and there's low volatility involved. So yes, that's our bake model in a nutshell. It's in version 4, which hasn't been released yet. Version 4 is still during testing stage, but it's performed better than version 3. It's outperformed version 3 by, I think, it should be here. So in terms of hyper, yes. In terms of hyper, what is it? I guess one thing. This is a version, 4 for hyper, using the DFTA. This is hyper version 3 using DFTA. And, there's significant improvement involved, and it's more fluid. So, yes, that's our models in a nutshell. Again, the bake model is not directly involved in, trading. It's more of a fine-tuning architecture. It's more of a subset of our whole entire Amphithean system. But, yeah, that's our 8 models in a nutshell. So, thank you for listening. And, as always, if you have any questions, feel free to comment.